In investing, the ability to move capital quickly can be the difference between capturing an opportunity and missing it completely.
The dollar liquidity infrastructure for global commerce.
In investing, the ability to move capital quickly can be the difference between capturing an opportunity and missing it completely. Imagine a market opportunity opens, a distressed asset becomes available, or a private investment is oversubscribed, or a government bond is being offered at an attractive yield. The investment team has done the work. They have completed their research. They want to go ahead, but the money is not moving. It spends the next 3 to 5 business days moving through the banking system. And by the time it arrives, the opportunity may have already gone. With my experience guiding businesses, sending payments across borders, one thing I've learned is this: sometimes the biggest risk is not the investment, it's the delay in moving the money. Today, I want to explain why asset managers around the world are beginning to pay attention to stablecoins, not as another investment opportunity, but with a better financial infrastructure. Let me explain to you what this looks like in the real world. Imagine you are managing a fund in London. Your investment team identifies an infrastructure project in Kenya, or a private credit in Nigeria, or government bonds in Brazil. The investment makes sense. You have done your due diligence. You are ready to invest. But before you can, the money has to move. You made a wire transfer. It passes through correspondent banks, compliance reviews, settlement systems, different banking hours, different time zones. 3, 4, sometimes 5 business days later, the money finally arrives. Sometimes longer. And by then, the investment terms may have changed. The opportunity may have disappeared. The best investment idea doesn't always win sometimes. The faster the payment wins. And now, imagine something different. Instead of waiting days, your treasury already hold digital money, digital dollars. You send them directly to the receiving institution from your secured wallet to their wallet directly. International payments made within minutes. The investment gets funded and you quickly capture the opportunity. Nothing about your investment strategy changed. The only thing that changed is the infrastructure moving the money. Today, I believe there are 3 challenges almost every asset manager faces when moving money internationally. First, settlement speed. Traditional cross-border payments takes days, like you already know. While that money is moving, it's not investing. It's not earning anything. It's simply waiting. And in public markets, that can mean missing an opportunity. In private markets, it can delay an entire closing. And at the institutional scale, those delays becomes very expensive. Second, foreign exchange timing. Here is something many people don't think about. The exchange rate you see when you initiate an international transfer. It isn't always the exchange rate when the money finally arrives. Over 3 to 5 business days, currencies move. Now, imagine moving $10 million and 1.5% currency movement happens. That's $150,000. That is already a loss against that investment, simply because the payment system was slow. But when settlement happens in minutes instead of days, that timing window almost disappears. Third is access to global opportunities. Some of the most attractive investment opportunities today are in the emerging markets. I mean, infrastructure financing, private credit, energy, commodity trades, agriculture, technology, real estate. But many of these markets still depend on slow corresponding banking systems. Sending the funds to invest is one thing. Repatriating your funds or gains is another story. And that's why many asset managers hesitate to invest in the emerging markets. Digital dollars introduce another way to settle international payments without relying entirely on traditional banking rails. That doesn't replace the banking system. It gives institutions another tool. And for many asset managers, that's not just more convenient, it's a new capability and a new market opportunity. A question I get a lot is, are institutions actually using this? And the answer is yes. And they are doing it for two simple reasons: faster settlement and treasury management. BlackRock, the world's largest asset manager, launched Build, a tokenized money market fund. Franklin Templeton also launched a tokenized money market fund. Hamilton Lane brought private equity onto blockchain infrastructure. JP Morgan, Goldman Sachs, Fidelity, Citi, BNY, all building digital settlement infrastructures. So think about that for a moment. The world's largest financial institutions are trying to create they are not trying to create another cryptocurrency. They are modernizing how money moves globally. They are modernizing how liquidity moves, because better infrastructure creates better financial products and services for customers. Now, so you can see the distinction. We are not talking about investing in cryptocurrencies or investing in stablecoins. We are talking about using the technology as, to modernize treasury infrastructure. We are talking about using them as treasury infrastructure. Think of it like inventory sitting on a warehouse shelf. Except in this case, your inventory is money. A fund that holds digital dollars isn't making a crypto bet. It's holding the dollars um, in digital form, ready to move whenever opportunity appears. Friday evening, Saturday afternoon, public holidays, different time zones, it doesn't matter. For global investment firms, that means fewer delays, better liquidity management, better cash flow, better treasury operations, infrastructure. So, infrastructure matters. Now, there is another development that's becoming increasingly important. Most stablecoins today simply owe their value. Yes, they digitize money, but they don't generate you. They don't make your money productive. And that's very important. Yes, we have digitized money. The next phase is making your money productive. For regulatory purposes, they call it rewards or incentives for liquidity activities. So imagine a fund holding $10 million while waiting for the next investment opportunity. That money is simply sitting there waiting. Yield bearing stablecoins solve that problem of idle funds. They maintain their one-to-one value with the currency that they represent. So, for an example, US dollars. But the reserve assets behind them, for example, short term US Treasury bills, generates yield. That yield is shared with others. So now your treasury doesn't have to choose between liquidity and return. Your money can remain available while continuing to work. So for institutional treasury management, that's a meaningful improvement. Now, let me speak directly to fund managers across Africa, Latin America, Southeast Asia, and the other emerging markets. Because I believe this is where the opportunity becomes even bigger for years. Many investment firms have not been limited by a lack of opportunities. They've been limited by the payment systems, access to US dollars, slow settlement, limited correspondent banking relationships, higher transaction costs. So the investment opportunities have also always existed, but moving the money has been the challenge. Digital dollar infrastructure doesn't remove every regulatory requirement, but it removes a significant amount of operational friction. That means faster deployment, better liquidity, greater access, and the ability to compete more effectively in global markets. The advantage isn't simply speed, but it is access to capital, access to counter parties, access to global opportunities. And I believe the firms that begin to understand this infrastructure today will be in a much stronger position tomorrow. So, what should asset managers be doing today? First, understand the technology. Not because it's fashionable, but because financial infrastructure is changing at a fast speed. You will hear people, saying the train has left the station. Second is look carefully at your current operations. Where are you losing time? Where are you losing money? Where are you losing opportunities? Where does unnecessary friction exist? And third is start running controlled pilot programs. Learn early, experiment responsibly so you can understand how digital settlements fits into your existing investment process. Because That's usually where competitive advantage begin. Technology alone doesn't transform an investment firm. People understand how to use it. The future of investing isn't only about finding better investments anymore. It's also about leveraging modern financial solutions that are being built now. If you manage capital, whether it's a family office, an investment fund, a pension fund, a sovereign wealth fund, or institutional capital, I genuinely love to hear how your organization is thinking about digital settlement. So reach out and let's continue the conversation. And if this series has been helpful, share with someone else, follow along, and watch out for the next episodes. Because once you understand how money is moving and how money is changing, you begin to understand where the future of finance is going. And that's how you can position yourself to participate and enjoy the opportunities it enables.
The dollar liquidity infrastructure for global commerce.